Hey there, welcome back to the channel. In this video, I will explain what option contracts are and how they can be lucrative for you if you choose to invest or trade them, while also looking at the high risk that does follow them. For those of you who are new, my name is Cash, and on my channel, I focus on the markets. I provide my thoughts and insights on the market and really try to focus on sharing opportunities to build wealth. I'm sure many of you have heard of option contracts before, but may not be entirely sure as to what they are and how they work. As an example, say we want to purchase shares of a company, this would be known as purchasing equity. When you choose to purchase 3 shares of, say, Apple, for example, you now directly own a piece of the company. Unless you choose to sell those 3 shares, or if for whatever reason a corporate action were to occur, such as a stock split or a reverse split or any type of delisting from the exchange, you directly own these shares forever. Now, with options contracts, each options contract has 100 shares in it. That's standard. Now, when you choose to purchase one options contract, you're not purchasing the 100 shares in the contract. What you are doing is purchasing the right to be able to buy or sell those 100 shares at a set price, which is known as the strike price. However, you aren't obligated to buy or sell the shares. There are a few reasons why someone may want to purchase an options contract, which I will get into. So, there are 2 types of options contracts that can be purchased, which is either a call option or a put option. If you're planning to purchase what is called a call option, it provides you the right to be able to buy the 100 shares in the contract down the road at an already set price, known as a strike price, if you are in a position where you're not able to purchase the 100 shares right now. If you are planning to open up a short position, but for whatever reason are not able to at this moment, you can exercise what instead of a call option would be called a put option. A put option gives you the right to sell those 100 shares in the contract that you do not own at a set price, strike price, down the road to initiate a short position. Now, to perhaps the most important reason, why would someone purchase an options contract? The reason being would be to potentially make huge gains in a shorter time span. If you think that either the share price of the company Apple, for example, is going to rise substantially in the upcoming months, or you think the share price is going to decrease substantially over the coming months, you can use the purchasing of an options contract to potentially make money from this event. The reason being is that option contracts, unlike just purchasing stocks, do have something attached to it, which is known as time decay, and options contracts also have an expiry date. Now, this video itself is just the basics on options contracts. The next video that I will release will go a bit more in depth on call and specifically put options and all other important information pertaining to them. But as an example, say you buy one call option contract. Remember, call is a right to buy, put is a right to sell. So, say you buy one call option contract, which gives you the right to buy 100 shares at a set price. The call option may look something like this. 1 Apple, November 19th, 2021, 145 call at $9 limit. So, 1 Apple stands for 1 Apple call options contract. November 19th would be the date this contract expires. 145 would be the strike price or the set price per share that you can exercise the contract at, and $9 would be known as a premium. How this would work is, say the Apple share price is currently trading at $144. With the strike price on this contract at $145, this means that between now to November 19th, the expiry date of the contract, if the share price was to go above $145, which is your strike price, say it goes to $170 in the next 3 weeks. This means that you would be what is called in the money. You have made profit on the options contract since this contract gives you the right to buy the shares at $145, even though the shares are now trading at $170, and you have the flexibility to either sell the contract itself and take the gains and move on to something else, or you can exercise the contract, buy the 100 shares at $145 and now own the actual shares themselves. Now, you may be asking, what is the $9 premium for? The $9 premium is what you pay per every share in the contract to be able to own this contract. This is essentially the price you pay to buy the contract itself, excluding any additional commission fees that your broker or dealer may charge. So in this instance, to buy this one call option contract, which gives you the right but not the obligation to purchase the 100 shares, it would cost you $9 times the 100 shares in the contract, equaling $900. In a way, from the time that you purchase this one call option contract, you can say that your break even per share would be $154, since your strike price is $145 plus the $9 premium you pay per share. Now, the most important thing to take into effect is the time decay and the expiry of the contract. Because there is an expiry date, if the share price was to exceed your strike price of $145 sooner than later, say it were to hit $170 1 week after you buy the call option contract, the value of your contract in a short span of time would increase much more significantly due to the fact that you still have from July almost a full 4 months until the contract expires, meaning that the share price still has a lot of time to run even higher. However, where the risk comes into play with options contracts is specifically for this call option contract, where we are buying the right to purchase the shares at a set price. If the share price, for example, goes to $140 when your strike price is $145, you would be considered what is called out of the money, because why would there be value to exercising your contract or selling it to someone else when the shares can now be bought on the market at a cheaper price, being $140. If at expiry of the contract, the share price is trading lower than your strike price, your contract expires worthless, meaning that the premium you paid, which was $900, including any additional commission costs, you will lose. Even if the share price is trading exactly at the strike price at the time of expiry, you still lose due to the fact that you paid a $900 premium to own the contract. The most that you can lose on a call option contract is the premium amount that you pay, plus your commissions that your broker charges you. The value of your options contract or contracts will constantly fluctuate based on how the company's share price is trading and also based on the time passing by until expiry. This is why you have to monitor the contracts closely, and also why, although you may be able to achieve larger gains in a much shorter time span rather than just owning the stock, they do come with much more risk due to the expiry and time decay, where you can end up losing it all. Put options follow a much similar process, which I will explain in detail in my next video, where instead of having the right to buy the shares in the contract, you have the right to sell the shares at a set price. Again, to remember, call options, you hope the share price goes above your strike price. Put options, you hope the share price goes below your strike price. I will also touch upon American versus European options and other important things to consider if you do plan to invest in these vehicles. With that being said, if you enjoyed the video, please feel free to like it, subscribe to the channel, and ring the bell for notifications. And until then, we'll chat soon.